Have you ever wondered how central banks stimulate economies during a financial crisis? That's a thought that has intrigued many. Central banks are pivotal in directing economies. They're akin to the maestros of a massive economic symphony, guaranteeing all components harmonize. But what if the tune falters? When economies falter, central banks have a secret strategy: quantitative easing. This isn't a whimsical enchantment, but a complex fiscal device. Known as QE, it entails central banks generating new money digitally. This fresh capital is then utilized to purchase government or corporate bonds, infusing additional liquidity into the economy, much like a monetary energy boost. It's a courageous strategy, somewhat akin to triggering the turbo boost in a sluggish economy. So that's what quantitative easing is. But how does it impact the financial markets? Stay tuned to find out. Quantitative easing, or QE as it's often referred to, sounds complex, but it's simpler than you might think. Essentially, QE is an unconventional monetary tool central banks employ to stimulate the economy. So how does this magic trick happen? Central banks digitally create more money, not printing, but by increasing the balance in their accounts. This newly minted money is then used to buy financial assets, government bonds, corporate bonds, and the like. Why this peculiar shopping spree? The purpose is to infuse more money into the economy. When central banks purchase these assets, they effectively give more money to the asset owners, who then reinvest it into the economy, stimulating economic activity. This buying frenzy also increases asset demand, pushing their prices up and consequently lowering their yield. Lower yields can make borrowing cheaper, spurring spending and investment, thereby boosting growth and employment. But QE isn't a panacea. It's a last-ditch effort when traditional tools fail, like when interest rates are already too low. It's a defibrillator for the economy, giving it a shock to reanimate it. But QE is a potent tool that must be used judiciously. It can create unwanted side effects like inflation or asset bubbles. This influx of money can have a significant influence on the financial markets, which we'll delve into next. Now imagine a pond, a pebble drops into it. The ripples, that's quantitative easing. Like a pebble disturbs a tranquil pond, quantitative easing, or QE, disrupts the financial markets. This is a tool used by central banks to stimulate the economy, primarily by injecting money into the financial system and purchasing assets such as government bonds. The result is increased money in circulation, creating impact across the financial markets. The first ripple affects interest rates. Central banks purchasing bonds lower their rates. When bonds are in demand, their prices increase and their yields decrease, making borrowing more affordable. This encourages investments and expenditure. The second ripple impacts asset prices. Lower interest rates direct investors towards higher returns from stocks, real estate, and other assets, pushing their prices up. This wealth effect encourages further spending. The final ripple causes a surge in spending and investment. Lower borrowing costs and increased wealth encourage more economic activities, leading to potential growth and higher employment rates. Therefore, the financial market pond is constantly affected by the ripples caused by the QE pebble. As a potent tool, QE has the ability to stimulate spending, push the economy, and inflate asset prices by just increasing the money supply. But every action has a consequence. What happens when quantitative easing ends? The ripples fade, the pond settles, but what's left in the aftermath? Well, that's a discussion for another scene. The end of quantitative easing is like the calm after a storm, with its own set of implications. When a central bank decides to wind down quantitative easing, it's like a juggler catching all balls at once. There's a balance to maintain, and if mishandled, results can be chaotic. Let's discuss interest rates. They've been low during quantitative easing, making borrowing affordable. But as quantitative easing ends, interest rates may increase. This can make borrowing pricier, potentially hindering economic growth. Now onto asset prices. During quantitative easing, central banks buy bonds and assets, inflating their prices. Once this ends, demand for these assets decreases. This can lead to a decrease in asset prices, impacting everything from home value to retirement savings. Market volatility is another factor. The markets have relied on the security of quantitative easing. Its absence can cause market volatility. Nevertheless, it's not all negative. The end of quantitative easing also indicates the central bank's faith in the economy's strength. It's a positive sign, an indication of economic recovery. So, what's the takeaway? The aftermath of quantitative easing is a mixed bag. It involves potential for increased interest rates, decreased asset prices, and market volatility. Conversely, it also signals economic recovery. But remember, like all economic tools, the impact of quantitative easing can vary based on numerous factors. It's a complex process, with effects as unpredictable as the weather. Yet by understanding its potential implications, we can navigate the economic landscape better. So we've journeyed through the concept of quantitative easing and its impact on financial markets. This economic strategy is much more than merely pumping money into the economy. It's a calculated maneuver by central banks to stimulate growth. We delved into the mechanics of it, tearing away its intricate layers to reveal the fundamental principles involved. Through our exploration, we've established how quantitative easing can affect markets, from lowering interest rates and boosting asset prices to fostering a wealth effect that encourages consumer spending and investment. However, we didn't overlook the potential pitfalls that could come once quantitative easing is withdrawn. From the potential for market instability to the risk of inflation and the daunting task of retracting the large-scale asset acquisitions made during the easing, tackled these daunting prospects head-on. Understanding the complexities of quantitative easing demystifies the financial jargon, giving us a more informed perspective on the ebb and flow of our economy. The next time you hear about quantitative easing in the news, you'll have a clearer understanding of what it means for the financial world.